We're speaking with Joseph Keating. He is the Chief Investment Officer at RBC Bank. Okay, so we talked about some dividend stocks in the consumer staples sector. You talked about Colgate-Palmolive, Procter & Gamble, as well as Pepsi, as well as some of the master limited partnerships for the pipeline companies. What about in the telco space? Do you like telco stocks for the dividend-paying ability?
You know, I do, Pim, and one of the real interesting things about being a dividend player is I don't have to choose between AT&T and Verizon, the two big dominant.
You get to buy
firms.
both if you want.
I buy them both, and I like them both. They both have dividend yields over 6%. AT&T is number one in landline, number two in wireless. Verizon is the flip, number one in wireless, number two in landlines. AT&T obviously has the kicker with the iPhone. We own them both. We like them both. We think they're going to be great earners and dividend payers for a long period of time. So I would encourage investors to own them both.
Now, when you say a long period of time, in a sense, you have to be a long-term player to really get the advantage of dividends, because otherwise, to explain a little bit about the tax issues, because unless you own the stocks for a certain period of time, both before and after they pay that dividend, you're not getting that beneficial dividend tax rate.
Yeah, right, exactly. I think it's 90 days on either side in terms of making sure that you get the 15% today and propose to be 20% tax rate going forward. Absolutely. But I guess my distinction there, Pim, is there are some pretty good regional, rural telecoms out there. Windstream is one, and we've owned it in the past. Frontier is another. But in today's slow growth economy, I want to be, particularly with the dividend yields being up over 6%, I want to be with AT&T and Verizon. It's just a safer place to be.
We'll talk about safety, because, I mean, a lot of the dividends are, well, they do come under pressure, right?
Absolutely.
I mean, we were in a situation where, for example, Dow Chemical, dividend-paying stock, well, not such a dividend-paying stock.
Here's a great example, Kim. If you go back 2 years, the largest dividend-paying sector of the S&P 500 were the financials.
That's right.
You don't own financial stocks today for dividends. You know, I think maybe you own them for a bounce back, but that's not my world. We're not owning financial stocks today, and we haven't for quite a long period of time because the sanctity of the dividend just isn't there. Most of them have cut their dividend down to a penny in order with the TARP funds and all that. So you know, if you weren't watching what was going on in the world and you were a dividend player and you own financials, you really took it on the chin. So you've got to watch what you're doing, and at some point financials will probably become a good dividend paying sector again, but I don't see it in the next couple of years.
What if you like dividend-paying stocks? What about preferred stocks, whether it be in the financials or there are preferreds in a lot of other industries?
There are some good preferred stocks. The issue with the preferreds is that one, the dividend doesn't grow. That's what we like about the common stock dividend. And secondly, you're not getting the preferential tax treatment on a preferred dividend as opposed to a common stock dividend. So there's a place in someone's portfolio for bonds and preferred stocks and et cetera, but we really focus on the common stock dividend-paying world.
What would cause you to jettison the dividend-paying strategy? I mean, would you have to see higher headline inflation?
Well, the companies that we're invested in, they'd probably ride a higher rate of inflation fairly well.
They get that pricing pressure.
They get the pricing pressure. So, you know, in our view, our investors are either building assets for retirement or they're in retirement. And if you're building assets for retirement, reinvesting that dividend is a consistent and careful and slow way to build wealth over time as you move into retirement. And then when you're in retirement, that dividend is a great thing to have, and to have that dividend grow while you're in retirement helps you keep pace with inflation. That's why we're really focused on the dividend.
Now, what I want to press you on is, now you've had a lot of contact with clients, as you say, nearing retirement or in retirement. How shell-shocked is the customer base right now? I mean, they're still repairing their own personal balance sheets, their own personal portfolios. Even though we've had this run-up since the March 9th lows, we're really only back to where we were in November.
That's right. People are concerned. There's no doubt about that, Pim. I will tell you that ours, while we lost money during the bear market, everyone lost money during the bear market, being in dividend-paying stocks, we lost less than the average investor or the typical market average. So So ours are doing a little bit better. The other thing is, if you were reinvesting that dividend during the bear market, you were buying additional shares at pretty attractive prices now. And so there's that whole compounding thing that works with a dividend flow on the portfolio that you can reinvest at lower levels.
All right. Now, when you talk about the dividend-paying stocks, are you at all interested in overseas stocks that are paying dividends?
We are not. The breadth of our coverage is domestic. Now, that doesn't mean that it's not an interesting thing for someone to do, but our focus is on domestic dividend pay. I think, when you're in the money management business,
going to the dollar. I'm going to the whole thing about the dollar stuff here now.
No, but I'll play the dollar through Procter & Gamble, Colgate-Palmolive, and Pepsi. The majority of the sales of all three of those companies is overseas. And so as the dollar has come down this year, and it might come down some more, they benefit from that, as opposed to the pipelines or utility stocks where there's no dollar play involved there because they are truly domestic companies.
All right. Now, another area of focus for dividend-paying stocks has always been pharmaceuticals.
Right.
Now, you've got some caveats when you're looking at pharmaceutical companies, right? You say stay away from the ones that, have some drugs in the pipeline.
Or that maybe the pipeline isn't as strong as you might like it to be, and therefore they're going to have drugs going off patent. I mean, Pfizer is a classic example. We were very concerned about Pfizer. We did not own Pfizer. We didn't think the dividend was sustainable. They go out and they make the acquisition of Wyeth, and then what they do to help pay for Wyeth? They cut their dividend, Pim. So while that helps fill their pipeline, they're filling their pipeline by cutting their dividend. So we have basically stayed in three stocks. We've stayed in Abbott. We've stayed in Johnson & Johnson. We've stayed in Lilly. We're buying Abbott and Johnson & Johnson at the moment, and it's because they have broad product lines.
All right. I want to thank you very much. Joe Keating coming and sharing your thoughts about dividend-paying stocks. Look forward to having you back to follow up on all of the stocks that you've talked about. Thanks again from RBC Capital.